Hello and welcome to Business Standards, the morning show. I am Debargya Sanyal and here are the top stories for the day. Consumer inflation soared to 6.52% in January after staying within the RBI's tolerance band for 3 months running. The sharp jump not just betrayed the pain that the consumers have been going through, but also justified the RBI stand, which has refused to take its foot off the rate hike pedal. So, is the retail inflation going to haunt us, or is this just a blip? Here are all the answers. In the middle of January last year, as the government announced that December's retail inflation had declined to 5.72% from November's 5.88%, a chorus for a pause in further repo rate hike gained momentum. But RBI Governor Shaktikanta Das called for caution. Just a few days later, he expressed concern about the sticky core inflation, saying that it was not a comfortable number to deal with. We have to be very vigilant, the governor had stressed last month. And it looks like he was right. India's retail inflation reversed its downward trend in January and once again breached the central bank's upper tolerance limit of 6% after a gap of 2 months, prompting analysts to project another rate hike by the RBI's Monetary Policy Committee, or MPC, in April. Data released by the National Statistical Office on Monday showed the Consumer Price Index, or CPI-based inflation rate, rising unexpectedly to a 3-month high at 6.52% in January from 5.72% in December, as food prices led the rise in prices across categories like housing and services. Core inflation, which excludes food and fuel prices, remains sticky above the 6% mark. The surprise U-turn in inflation numbers comes only days after the RBI revised down its January-March quarter retail inflation forecast by 20 basis points to 5.7%. The latest MPC meet in February also hiked the repo rate by another 25 bps, while cautioning that further calibrated monetary policy action is warranted to keep inflation expectations anchored. Meanwhile, the wholesale price-based inflation declined to a 2-year low of 4.73% in January. So, is the sharp increase in CPI number a temporary blip, or is this part of a larger trend?
I think it's definitely worrisome because it has crossed the 6% tolerance barrier. And also, I think we are seeing some persistence in cereal inflation, so which is also worrisome. And then the biggest worry is on the core inflation front, which is above 6% and has gone up marginally in the month of January. So I think all these things are making inflation more broad-based.
On the other hand, if you look at what's been happening to the WPI continues to come down. So that if you think about the overall sort of inflation scenario, so the WPI is softening continuously, and it's been doing so for a significant period of time. And my personal reading is that the CPI number is a blip, and we should see a correction next month.
This is more of a blip because, frankly speaking, we did not expect a number of 6.5%. We were looking at something closer to 6.1%. So quite clearly, our calculations had gone wrong. But if you look at generally the entire basket of commodities which are within this particular CPI, we have seen that while the core inflation number was more on expected lines at 6.1%, I think we've seen certain kind of noise elements, especially in the cereals section of the food basket, as well as the fuel and light basket. So I would tend to think that the number will remain elevated, but probably 6.5 would have been the peak number which would have been achieved. And the number should be gravitating closer towards the 6% number in the next couple of months.
What does this mean for FY24 inflation and growth projections by RBI? And does this vindicate RBI's stance on continuing vigilance on inflation?
So I think RBI's vigil on inflation is justified because, as I said, it is showing signs of broad basing again. I mean, which is not a good thing. But it's not going to be anywhere near 4% where the central bank wants to target it. I mean, our forecast is 5% CPI inflation. RBI expects it at 5.3%. So I think there is still, it is above what is called the comfort level of the central bank.
In case it does turn out to be as bad as 6.5% or something higher, then I'm quite sure that the MT would pitch for another rate hike before you go in for the pause. But if the number keeps moving downwards, I think we could be expecting the RBI to take a pause on further rate hikes. Yeah, I think a time has probably come that we need to sort of be aware of the fact that India is generally an economy which has relatively high inflation. And while it's okay that the MPC has been asked to target 4%, I think that targeting a higher number in the region of 5% would probably be a bit more prudent.
And what does it mean for the Indian economy?
As of now, I wouldn't worry. Consumer sentiments in any case are not particularly robust. And so this is not going to change that position one way or another. I don't think consumer sentiments are going to get a lot worse, which then lends a certain amount of credence to Governor Das's position.
I think the surprise element has definitely been on the cereal side, which is, we're talking about wheat. And I think wheat is quite critical because it's a Rabi crop. They're going to have the harvest right now. So I think the climatic conditions which will be influencing the wheat output would be of great importance. And that has ripple effects, not just for the wheat output, market sales and the government procurement, but it will also have an impact in terms of all the food products, because there are several food products which are wheat-based. And once these costs get embedded, there would be a tendency for generalized inflation to also take place.
In its February MPC, the RBI had left the door open for more rate hikes. Now, with the surprise in the inflation print, the central bank may find it prudent to exercise that option. The ongoing Adani fiasco is yet another burning issue which is keeping the central bank busy these days. SEBI too is on its toes. The government on Tuesday agreed to the Supreme Court's suggestion to form a panel that will look into existing investor protection regime against the backdrop of the rout in Adani Group shares. So what can this panel do to ensure that investors don't lose their wealth to another such meltdown? Bhashwar Kumar's report has the answers.
On February 13th, the centre agreed to the Supreme Court's suggestion of setting up an expert committee to strengthen the regulatory regime for Indian markets. The purpose of this panel will be to ensure that market investors are protected. The development comes after a critical report by US-based short seller Hindenburg Research led to a massive slide in the stock prices of Adani Group companies. The group's stocks fell 50% in the aftermath of the report. In a matter of days, it lost over 9 trillion rupees in market capitalization. At the same time, SEBI's submission to the Apex Court said that the markets regulator was inquiring into the allegations made by Hindenburg against the Adani Group and its impact on the markets. Released at the end of January, the Hindenburg report accused the Adani Group of stock manipulation and improper use of offshore tax havens. The group has denied any wrongdoing. Appearing for the Union government, Solicitor General Tushar Mehta told the Apex Court that the government believes that the existing regime, regulators and agencies were fully competent to deal with such situations. Despite that, Mehta added, the centre would not oppose the court's suggestion of an expert committee for strengthening the existing regime. For the proposed committee, the government has agreed to share the names of domain experts with the Apex Court in a sealed envelope. Earlier, the Supreme Court had sought a response from the centre and SEBI by February 13th on the steps needed to improve regulatory and statutory mechanisms to ring-fence investors against the kind of volatility seen in Adani Group shares. On February 14th, Adani Enterprises reported a consolidated profit of 820 crore rupees for the third quarter of the current financial year. This was an improvement from a loss of almost 12 crore rupees a year ago. While the group grapples with the fallout of the Hindenburg report, the allegations against it have also raised apprehensions that confidence in the broader Indian markets could take a hit. Against this backdrop, what can the proposed expert committee do to improve investor protection?
The crux of the Hindenburg allegation is the issue of round tripping. Many of the FPIs, that is the foreign portfolio investors, the ultimate beneficial owners of these FPIs may not be known. And this is an age-old problem. So from that perspective, I think much more needs to be done from a regulatory scrutiny of the FPIs, from a KYC perspective, know your customer and the ultimate beneficial individual owner of these FPIs, to whether they are funds for any Indian entities or businessmen or politicians or bureaucrats or others. So these are issues which are not easily answerable, but definitely much more efforts need to be put.
You ask anybody who has been closely associated with the markets, they have sometime or the other come across or invested in a stock which was being manipulated. If one does a preliminary check on the valuation vis-a-vis the other stocks in the same sector, or checks the steep movement in the said stock without much of a justification, one can fairly conclude that they are being manipulated. I feel this expert committee should have their ears to the ground, should have analysts onboarded who could study the suspects and confirm whether further investigation is needed or not. Where there are allegations of round tripping, and that too across geographies which include tax havens, the job of the regulators get that much tougher. They may also need to involve other investigating agencies, and reaching a conclusion in such cases also becomes difficult and could take long.
There are also some steps that the panel could take to address Hindenburg's conduct and to reduce the potential for similar events in the future.
Any derivative instruments which is created outside the regulated market, I think in some form, these particular instruments are injurious to the overall health of the market and the economy in general. Given the situation in which I think the swap instrument has been created by using the P-note route by the research house who has shorted the bonds of Adani groups, this is something which is quite unpredictable per se on one side, and at the same time I think it's quite detrimental to the very health of financial markets on the other side. So the recommendation here would be that if at all any investor or a trader who wants to create an instrument, it has to be operated onto the platform, market platform in India where the stocks are listed and under the regulatory environment. I think the panel should suggest that I think any instruments operating outside the country, that too in a non-transparent manner, this cannot be treated as a regular instruments or legal instruments. I think this should be, definitely taken up very seriously with the counterpart regulators in the other part of the world.
Their first remit, or the first question that expert panel will have to examine, that in India you have got all the laws which control short position, short selling, and there is a risk management mechanism which is online mechanism, and I can put it on record that Indian exchange risk management mechanism is the best in the world. So they are saying that while you have mechanism to control short selling here, but there is no mechanism to control a short selling through the structured derivative products which happens outside Indian regulatory regime. So there are two challenges. One is first how to know that any short position is being created. The second, if it is being created, how you can bring it to Indian regulatory regime.
Apart from allegations made against Adani, are there any other parts of the Hindenburg report that need to be addressed? For example, the report says that India's economy has been held back by the broken state of its capital markets.
To paint the market with the same brush and to state that it's a broken state of capital markets is absolutely a figment of their imagination. We have one of the robust systems in place for the exchanges. Even a major market crash in 2020 saw our exchanges working smoothly. Corporate governance standards of our listed entities have improved tremendously in the past few years. And we have been consistently been rated high by global bodies of banking and capital market regulators. So I don't think we need any certificate on this from Hindenburg.
Overall, experts are confident of the Indian regulatory regime's fitness. However, with the increasing popularity of India as an investment destination and the growing stature of its companies, it may be time to not only improve the framework but also update it to manage risks emanating from foreign shores.
Meanwhile, new age technology stocks have been on investors' radar for a while. Shares of Nykaa, Paytm, and PB Fintech have surged up to 17% in a month. However, these companies reported a mixed set of results during the third quarter earnings, keeping analysts cautious over the sustenance of their strength. Lovisha Darad's report has more.
Shares of new age technology companies saw renewed buying interest over the past month. Shares of Paytm, FSN e-commerce ventures, PB Fintech, and Car Trade Tech leaped up to 17% as investors pinned hopes on improved outlook post the October-December quarter results. In comparison, the S&P BSE Sensex rose 0.2% during the same period. During the December quarter, food delivery aggregator Zomato, for instance, saw its net loss widening to 347 crore rupees from 63 crore rupees a year ago period. Similarly, Nykaa's net profit plunged 71% year-on-year to 8.5 crore rupees from 29 crore rupees last year. Both companies, however, saw a sharp increase in revenues. On the flip side, Paytm and PNB Fintech comforted investors as their net losses narrowed in Q3 FY23. While Paytm's consolidated net loss narrowed to 392 crore rupees, PNB Fintech's loss stood at 88 crore rupees. Given the mixed set of results, analysts remain cautious over the sustenance of this recent rebound.
Because they only talk about GMV. I don't see any profit. No, growth is not important for me. Profitability is more important, which is not happening. So I stay away from there because I don't understand. Even the great Mr. Ramdev Agrawal has said, I have been pushed into Zomato. I feel very bad. Anyway, I have been very clear in this. So new age stock is something I don't understand, and I want something where my clients can make returns out of it. If it is a loss-making proposition, I will not. And you check Nykaa before IPO did very good. They showed good profit. Now the profit is only declining. So I better stay away.
That said, VK Vijay Kumar of Geojit Financial Services believes the companies are long-term value buys. New age digital companies will start performing once India's underperformance reverses. In Q3, Paytm and Zomato did reasonably well, but Nykaa's results came below expectations. The long-term growth potential of these companies is huge, and therefore will see buyers despite near-term challenges. Given the overall weakness in market sentiment, analysts suggest investors with high-risk appetite to continue adopting selective stock-based approach from a long-term basis. As regards today, market trend will be guided by earnings season, US inflation data, crude oil prices, and foreign fund action.
After the financial markets, let us move on to a debate raging around various models of pension schemes for government servants. Andhra Pradesh recently proposed a pension scheme claiming that it combines the benefits of both old and new pension regimes. According to a report, it has also caught the attention of the central government. In our next report, we tell you more about this new guaranteed pension scheme.
In the old pension scheme, or OPS, government employees used to get close to 50% of their last drawn salary after their retirement. It used to come from the government exchequer, and employees had no contribution in it. In 2003, the government scrapped the old pension scheme and introduced the National Pension Scheme, or NPS. Under it, employees and the government both equally contribute to the pension corpus, which is linked to the financial market. On retirement, the employee gets 60% lump sum, while the remaining 40% is invested in annuities for monthly pension. But in the last few years, at least 4 opposition-ruled states have reverted to the old pension plan, and Maharashtra too has shown its willingness to explore it. On their part, the RBI and the central government have warned against this trend, saying that it will put pressure on the exchequer of cash-strapped states. And amid this ongoing debate around old versus new plans, a new scheme proposed by the Andhra Pradesh Chief Minister Y.S. Jagan Mohan Reddy has caught everyone's attention. Proposed in April 2022 by Andhra Pradesh government, the Guaranteed Pension Scheme, or GPS, claims to bring together benefits of both the old and the new pension schemes. GPS offers 33% of the last drawn salary to the state government employees as pension. For that, each month, 10% of the basic salary will be contributed by the employee, and the government will also put in the same amount. Under the scheme, an employee can also contribute up to 14% of the basic salary to get a pension, which is equal to 40% of the last drawn salary. Andhra Pradesh's Finance Minister Bugana Rajendranath claimed that the market conditions will not influence the pension under GPS. He also claimed that pension under GPS will be nearly 70% higher than the current pension being offered under CPS, in line with the current interest rates. The Andhra government also said that the NPS, or CPS as it is called in the state, would give lower returns than the GPS. The centre has denied this.
By the nation's trusted bank, SBI, the banker to every Indian.
Experts, meanwhile, have advised caution, saying that states should resist opting out of the new pension scheme. It will put extra burden on the already stressed exchequer. That's all for today. For more news and analysis, please log in to businessstandard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.